Hello everyone, welcome back to Lulu's Real Way. I'm Ep07 and today we're taking a deep dive into creative financing in multifamily properties. Whether you're dreaming of owning a duplex, a triplex, or a small apartment building, or even a big one, understanding how to finance your investment is super important. But don't worry, we're going to keep it simple and I'll try to use realistic examples to keep everything clear. Let's get started. Before we jump into specific loan types, let's cover some basic terms. What is a loan and what is an interest rate? A loan is money that you borrow from a lender, like a bank, which you agree to pay over time with interest. Think of it like getting a financial boost to purchase a property that you might not be able to afford outright. Imagine you're trying to buy a fourplex that costs $400,000, but you don't have all that money saved up, so you take out a loan from the bank to cover most of the costs. Now, what is an interest rate? The interest rate is a percentage that the lender charges you for the service they provided, which is borrowing the money. Interest rate is how banks make money from lending. Now, who decides an interest rate? Banks set their interest rate based on the Federal Reserve's FED basic rate, plus additional basis points. The Federal Reserve rate is the rate at which banks borrow money from each other overnight. It influences overall economic activity. Basis points are the increments of 1/100th of a percent. For example, if the FED rate is 2% and the bank adds 150 basis points, your interest rate will be 3.5%. This rate affects how much you'll pay each month and the total cost of your loan. Next up is amortization. This topic is a little complicated, so music down, focus mode on, and let's dig in. Amortization is a fancy word for how you gradually pay off a loan over time. Each month or each payment period, a portion of your payment goes towards interest, or the fee that you pay for borrowing the money, and another portion goes toward paying the amount that you owe, called the principal. In the beginning, a larger share of your payment usually goes to interest because you still owe most of the principal. Over time, as you owe less, the interest portion gets smaller and more of your payment goes towards the principal. By the end of the loan term, let's say 30 years for a typical mortgage, the goal is to have paid off the entire principal plus interest in these small, steady increments. Let's have an example. Say I want to purchase a house for $100,000 and I chose a loan that requires 20% down, has 4% interest rate, and is amortized over 30 years or 360 months. Using a standard mortgage calculator that I really don't want to get you into because I really don't want to give you a headache. My approximate monthly payment, which is principal plus interest, would be around $381.93. Here's how this interest breaks down over time. Part of each payment goes to principal and part goes to interest. Interest portion is calculated each month by multiplying your loan balance by the monthly interest rate. So my interest is 4% annually. That would be 0.33 monthly. Subtract the interest payment from the monthly payment and you'll get your balance payment. So that remainder goes to your principal. Each month you pay off some of your principal and owe the lender less money. The new amount that you owe is the new balance, or ending balance, or remaining balance. So early in the loan life, most of your monthly payment goes toward interest because the loan balance is still high. But later in the loan, as your balance decreases, the interest gets smaller and more of your payment applies to the principal. By the final payment in year 30, nearly all of your monthly payment will be paying off principal. Amortization spreads your loan repayment over time and minimizes the risk on the lender's side. A clear picture of your amortization schedule can help you plan efficiently financially and track your growing equity. Understanding interest rates helps understand and avoid early payment penalties, also known as prepayment penalties. Some lenders will charge you a fee if you pay off your loan too early. Hence, prepayment penalty. Since interest rate is how banks get paid for their services, sometimes they will want to make sure they are paid fairly, if not in full. When a bank or lender gives you money, they're calculating how much they'll make in interest over the entire life of the loan. Say 10 or 20 years. And because of amortization, you are not paying in full in advance. If you suddenly decide to refinance or sell the property after just a couple of years, the lender doesn't get that extra interest or income they were counting on. To make up for this, they include what's called a prepayment penalty. And this penalty can be a flat fee, a percentage of your outstanding balance, or something that phases out over time. For example, it could be higher in the first few years and then gets lower over time. It's really important to read your loan documents carefully so you're not caught off guard if you decide or need to pay off your loan earlier than planned. Another pitfall beginner borrowers fall for is a balloon payment. In some loans, the lender will require the borrower to pay a large sum at the end of the loan term. Like, for example, you'll pay regular chunks monthly, but then be required to pay the remainder of the balance at once at a set point in time. This is called the balloon payment. It's super important to understand where you stand and account for it, whether you have a balloon payment on your loan or not. If you're not ready to refinance or sell the property, that balloon payment can hit you like a truck. Now let's discuss an important distinction in loans: recourse loans and non-recourse loans. And that means what happens in case a borrower defaults on a loan. In recourse loans, if a borrower defaults on a loan, the lender can go after their personal assets beyond the collateral if the collateral value was not enough at the time. Take an example. If Sarah defaults on her conventional loan for the fourplex, and at the time her fourplex market value is less than the debt value, the bank can seize the property and also pursue her personal assets and savings to cover the remainder of the debt. For lenders, this is taking less risk, as they can recover more if the borrower defaults. For borrowers, this is a higher personal risk if they can't repay the loan. In non-recourse loan, the lender can only seize the collateral, which is the property, if a borrower defaults. They cannot pursue any personal assets belonging to the borrowers. For example, if Tom defaults on his agency loan for the 6-unit building, the bank can take the property but cannot go after Tom's personal savings or any other assets. For borrowers, this is limited personal risk. For lenders, this is higher risk, and to mitigate that risk, banks often offer higher interest rates or stricter loan terms. Now let's talk about the different types of loans. First up, conventional loans. You've probably heard about these if you've ever looked into buying a home. They're typically offered by banks or credit unions and come with more straightforward requirements, like a good credit score, consistent income, and a certain down payment, often around 20%. The loan terms range from 15 to 30 years, with a fixed or variable interest rate. For single-family homes or smaller multifamily properties, this can be a good, simple option. However, once you start dealing with larger multifamily deals, the bank might tighten the requirements or offer less favorable terms. Now let's move on to what we call agency loans. This typically includes Fannie Mae, Freddie Mac, and HUD. They're referred to as agency loans because Fannie Mae and Freddie Mac are government-sponsored enterprises, meaning they're backed by the government but aren't fully owned by it, while HUD, or the Department of Housing and Urban Development, is actually part of the federal government. Because of their government tie-in, these loans often come with lower interest rates and can have longer repayment terms, which is great news if you're looking to buy a multifamily property. In many cases, agency loans have more stringent requirements for things like property conditions and occupancy rates, because the agencies want to ensure the property generates enough cash flow to comfortably cover the mortgage. You might also see specific guidelines regarding debt-to-income ratio, underwriting standards, or even how much experience you and your team have in managing multifamily assets. On the flip side, once you qualify, you can often access better rates and terms than you'd get from a typical loan, especially for larger apartment complexes. Essentially, you're benefiting from the government's desire to support housing opportunities. These loans are designed to keep stable housing available and affordable, so the agencies want well-run properties with a good track record. It might mean more paperwork and a longer processing time, but if you can handle the extra steps, agency loans can seriously boost your cash flow over the life of the loan. And if you want to count perks of the agency loans, they often have lower interest rates than regular loans because they're backed by the government. They have longer terms and sometimes more flexibility for multifamily property. And they are great if your property meets certain occupancy and revenue requirements. I personally love the HUD loans most for multifamily properties because HUD loans in particular can offer super long-term amortization periods, sometimes up to 35 years or maybe 40. This often means lower monthly payments, which may boost your profit. They also tend to have very competitive interest rates, which helps make the cash flow more predictable. The catch? They can be a bit more paperwork heavy and have strict property requirements, so you need to be patient with them. But if your property and team can handle the process, it's worth it. Imagine applying for a HUD loan on a 50-unit property. The application could take 60 days or more because the lender will want to see the property's financing for the past 12 months. They also want to see high occupancy rates, like 85% or higher, and even want to check local market stability.
Stop.
Next up is something you hear a lot about in the real estate world: bridge loans. Think of these as a temporary bridge that helps you buy or renovate a property and then refinance it into a more permanent loan. They're usually short-term, anywhere from 6 months to 3 years. The trade-off is high interest rates and fees because the lender is taking on more risk. When to use a bridge loan? If you find a great deal on a property that needs significant repairs or renovations before it can qualify for a more standard loan, or when you just want to close fast and can't wait for a lengthy approval process. Today's episode was a little complicated, I know, but guess what? We talked about conventional loans, which are the bread and butter option, but might not give you the best option for larger multifamily properties. We talked about agency loans, like Fannie Mae and Freddie Mac and HUD, which are often the go-to for larger multifamily deals, thanks to their lower interest rates and long-term. We also talked about bridge loans, that are short-term, more expensive loans that help you snap up a deal or fix a property quickly but come with higher risk and need a clear exit strategy. I also explained amortization and how you gradually pay your interest over time. And I mentioned 2 pitfalls. Always look out for balloon payments at the end of shorter term loans and understand any prepayment penalties that might slam you if you refinance or sell earlier than planned. I hope you have a clear idea now about different loan types and how the amortization process happens and what to look for on your loan document. If you have any questions or experiences you want to share with us, drop them in the comments below. I'm here to help you and would love to hear your stories as well. Thanks for hanging out with me for this breakdown. And if you found this helpful, be sure to hit that like button, subscribe to my channel, and ring the notification bell. Watch my previous episodes and keep an eye out for the future ones. See you next time on Lulu's Real Way.